Hi, good evening, everyone. Today is our third lecture of Audit and Assurance course for June 25 attempt. In our last two sections, we discussed about the basic introduction of the audit and assurance, types of audit and assurance, assurance like reasonable assurance, limited assurance, and then we discussed the elements of the assurance engagement, which was we discussed that there are 5 elements of the assurance engagement. First one is your three-party relationship. Second one is subject matter. Third one is suitable criteria. Fourth one was our audit evidence, or we can say sufficient and appropriate evidence. And last one was your issuing an audit report or the with suitable audit report. We discussed each element with examples in detail. After that, we discussed about the auditing standards, how auditing standards are designed. Today, we are going to discuss the remaining part of your chapter 1. In that way, we have some concepts like accountability, stewardship, then your agency theory basically. Then after that, we will discuss the overall objective of the auditor. We will discuss the benefits of the audit. We will discuss the limitations of the audit, and we will discuss the expectation gap. So starting with our concept of the agency theory. If you remember, if you have, there is a concept called agency, in which there are two parties. One party acts as a principal and the other party acts as a agent on behalf of the principal. So in case of company, when we say company, in case of company, shareholder act as a principal and directors act as a agent. Shareholders hire or appoint board of directors to run and manage company on behalf of them. So there is a relationship of the agent between the shareholder and the board of directors. This was the one concept. Second concept is our accountability. Like accountability is basically why we are discussing here. When you are given an opportunity, when you are given a position, you must be accountable for that. Because in our company, in our case, company appoints directors to make the day-to-day decisions and all the operational decisions, strategic decisions to run and manage the company. Then those must be accountable to the shareholders for all of their actions, their decisions, and everything. If you remember or if you know, in every country's corporate laws, Companies Act or company law, there are by default given powers to directors. They have to act in those powers, those limitations. If they do anything beyond those limitations without getting the approval of the shareholders, they will be held accountable. The shareholders have the right to make them liable for anything, any loss incurred to the business for their beyond the powers decisions or the actions. This is what the concept is called, accountability. The third step concept is called stewardship or the steward. This is when you are acting, when you are taking care of someone else's property. Okay, so that is called steward. When steward is basically the person who takes care of someone else's property. So in case of our company, our situation, board of directors takes care of the shareholders' property. What is that property? Company, right? They are the responsible for everything, every decision of the company. So then next concept is called fiduciary relationship. I have mentioned all these things here. You can see all that stuff from your chapter 1 of the Kaplan book. And then what is fiduciary relationship? This means the relationship of a good faith, right? Because you hire someone only when you have good faith in them. You give them you give authority to the person, or you give a decision-making position to a person which you believe that this person will be acting in a good faith and in the best interest of the company and best interest of the shareholders. So there is a relationship of fiduciary between the shareholders and the directors of the company. These are the basic some concepts that we are discussing here. Now the next thing is, what are the benefits of the audit? Benefits of the audit. There are multiple benefits of the audit. The first thing is, like we are discussing and we discussed in our previous sections as well, that audit enhances the credibility of the information. If there is an audit report attached to the financial statements, anyone who is reading the financial statements will be more confident He will think like, okay, someone has reviewed these financial statements who was competent in that area, right? So it will enhance the reliability, credibility of the financial statements. Now the next thing is, but it is a natural thing, it is a normal thing. When you do a work, even if you are doing with perfection, there are chances of some unintentional mistakes as well, right? So when you get that information reviewed by an independent person, independent reviewer, we might be able to identify something that you are not able to identify. So in that case, it will add value to your information. If there are any hidden or like unidentified misstatements, like errors or misstatements, those can be identified by the independent reviewer. The next thing is, if you see, if we are discussing previously, that there are chances that management might do frauds, they might misappropriate assets. Then if there is a, sorry, if there is a use of, okay, so if there is a or if the audit is happening every year, then the management will always have this thing in their mind that okay, if we do fraud, if we do misappropriation of the asset, then during the audit it can be identified and we can get it sued by the company shareholders, or we can get be terminated and all that stuff. So just because of this thing, the audit indirectly reduces the risk of management bias or fraud, etc. Now we already discussed the credibility of the financial statements. It enhances the credibility of the financial statements. The next thing is, like, when we auditors perform the audit, during the audit they go through everything. They obtained understanding of the operating procedures of the company. They reviewed a lot of stuff. They cross match, they cross verify, they test the internal controls of the company. First they obtain understanding how the business operations are working, how the things are going in a flow, right? If they are saying payments will be processed in this with this approach, three people will verify. This is the standard operating procedure. Now it is being followed or not, auditor will test it. How will he test it? He will ask them to give him the payment vouchers, payment documents. He will see, are those documents being signed by the respective authorized persons or not. If those are being signed, or if those are not being signed, this is basically control deficiency. So auditor, at the end of the audit, will communicate control deficiencies as well, which will help the management, which will help the company or board of directors to ensure the compliance of those deficiencies. Understood? So these are the multiple benefits of the audit when that is being conducted by the independent reviewer. Now, what are the limitations? If we have already discussed all these limitations in our previous sessions, now just I'm going through each one by one, so I can make sure that we have covered every single area of your study next chapter. If you remember, I discussed that in our financial statements, we do not give absolute assurance. Why? Because absolute assurance itself means that I am giving 100% guarantee that these financial statements are correct. But in audit, we do not give absolute assurance. Why? Because the one factor is we do not do 100% transaction audit. Second factor is, in the financial statement, there are certain estimated figures, judgmental figures. So about a judgmental figure, about this estimated figure, you can never say that it is 100% correct. It is absolutely correct. Making sense? This is your one limitation. The second thing, in some industries, some businesses, there is an inherent limitation. There's some certain inherent limitations that you cannot control, you cannot avoid, you cannot correctly measure or identify. For example, in case of the business that is operating in the chemicals industry, so its chemicals evaporation losses cannot be measured accurately, right? That is an inherent limitation. In case of your IT industry, your IT inventory, your NRV write down and all that stuff will also be estimated thing, because that is inherent in that industry's nature. Okay. So, and the second thing, in the some softwares, some accounting software that businesses are using or following, those have some inherent limitations. Okay. You cannot rely on those controls by default. So just because of all these limitations, you cannot give the 100% absolute assurance. Okay, for some areas that are appearing, but because the auditor only gives opinion when he has obtained reasonable assurance regarding all the areas of the financial statements. When I am saying reasonable assurance, it means it has obtained sufficient and appropriate audit evidence. But there could be some cases where the auditor might not be able to obtain any evidence regarding any area. Then what will he do? He will ask the management to give him a written representation that they have provided all the relevant information. Understood? For example, if you remember in accounting, financial reporting or accounting, there is a standard called IS 10, subsequent period accounting, subsequent periods, basically adjusting events and non-adjusting events. So in audit, we also consider the adjustments of those as well, because if there is an event that is required to be adjusted as per IAS 10, then if the management is not adjusting that, something happened after the closing year, after the financial year, and we are unable to identify, we cannot obtain any evidence regarding that because we did not came into our attention. What we do in our representation letter, we mentioned that management has informed us about all the possible subsequent events, and we asked them to sign that representation letter. It means we were not able to get any evidence regarding that, so that is why we are just relying on the management's statement. That could be wrong. This is the limitation of our audit, so we could not just obtain evidence about that specific area. Now, second thing is evidence is persuasive, not conclusive. Persuasive means if they have provided me with all the documentations that just to me convince me that this is accurate and everything, all that stuff, right? But still, in the anything which is persuasive or convincing, the probability of mistake is still there. Probability of error is still there. What is the probability of error? They might have prepared that document internally, right? So there's a chance they are convincing me with those documentation, but because I'm not sure about its accuracy and all that stuff, it is not conclusive. Conclusive is something that is giving you 100% surety about that specific area. That we call this is conclusive evidence. Means after when you see that specific evidence, there is no doubt left in that specific. For example, when you get bank confirmation letter. Bank confirmation letter is basically the letter that we send to the bank and we ask them to fill the balances of the company as per their records. Okay, when we receive that letter from the bank, we cross match that figures with the company's figures. If those are matching, it means that is the conclusive evidence. Because that corresponding party has confirmed the balances. It means the bank balance that is appearing in my accounting books, my balance sheet, that is 100% matching with the balance as per the relevant bank. So it is conclusive evidence. Making sense? This is the main thing. So, and we do not test all the transactions, all 100% transactions. That is why we are this is a limitation. That's why we give reasonable assurance. We do not give absolute assurance. Understood? This is because of this thing. When we do sampling, there are chances that in our sample we didn't get our misstatements. The sample size that we extracted from using our different software or different sampling method, we didn't get any errors or fraud transactions. There could be fraud in the business. There could be misstatements in the business. Just because of the sampling, we were not able to identify that area. That is called basically detection risk. When we will discuss the future chapters, we will be discussing this specific area in detail. These are the limitations. Now, next thing is we have to discuss the objective of the auditor. I think we have discussed in the previous section as well, but let's discuss this area. Objective of the auditor, I am already communicating this thing from lecture 1, that auditor's responsibility, objective or responsibility of the auditor is to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatements due to fraud or error. Okay, so this is the responsibility of the auditor to obtain reasonable assurance. When it is mentioned that to obtain reasonable assurance means he has to obtain sufficient and appropriate audit evidence. When we say sufficient and appropriate audit evidence, sufficiency has its own testing requirements. If we are meeting that specific requirement, it means that evidence is sufficient. When we say appropriate, there is a definition of appropriateness. If we are meeting, our evidence is meeting that definition criteria, it means our evidence is now appropriate as well. The evidence that is sufficient and appropriate, okay, only gives us the reasonable assurance about that specific area. Sufficiency deals with the quantity. Appropriateness deals with the relevance quality. Okay, if my evidence is not relevant, if there is nothing to use of the quantity, understood? That is the main thing. So auditor has to obtain all this stuff. Now next thing, then after obtaining sufficient and appropriate audit evidence, he has to express his opinion. What is the opinion? What are the types of the opinions? We will discuss in chapter later when we will discuss the audit report area. Okay, but as of now, we are just discussing the overall objective of the auditor, responsibility of the auditor. Then he has to express an opinion about whether the financial statements are prepared in all material aspects in accordance with the applicable financial reporting framework. If you remember, in our previous session, we discussed about the preconditions. There are some preconditions in the audit. Auditor has to confirm agree on the preconditions with the management before signing with the audit engagement letter. So if you remember in the preconditions, I told you the one precondition is that the management auditor have to agree with the management about the financial reporting framework that they are using. Is it suitable or not? Is it legally allowed or not? Okay, this is the main thing. So when we are, because why it is so important, because when we are expressing our opinion, in our opinion, we are explicitly saying that financial statements are complying with the applicable financial reporting framework. If in the country applicable financial reporting framework IFRS, we will be using the word in accordance with the international financial reporting standards. Why they have used the applicable financial reporting framework, so pupils can use the framework as per their own needs, whatever is being used in their relevant financial statements. Okay, now they have to give you a full report. Report is basically audit report. Here the report is basically audit report and communicate as required by SISAs. If you remember, if you just recall, I mentioned here that we communicate control deficiencies, right? So in addition to the audit report, we issue, like when I'm saying we, it means auditor, because we are discussing audit. We are discussing from the auditor's perspective. So when we say we will issue communicates as required by ISAs, ISAs requires us to issue management letter. It requires us to issue like communicate certain things, certain findings with the board of directors through the board letter. Okay, what are those things that are required to be communicated to the board of directors? What are the things that are required to be communicated to the management through the management letter? And there are certain things that different auditing standards requires us to communicate with the management or BOD during the audit period as well. When we are performing the audit, if there are some things comes into our attention, we are required to communicate those as well during the audit phase. But the board letter and the management letter are issued or means the communicated to the relevant personnel at the end of the audit when we are issuing the audit report. Clear? These are different requirements by different accounting standards that requires from us to communicate with the management or board of directors according to the requirements of that specific standard. Okay, this is what they are saying when about the auditor's findings. If there are any deficiencies, any recommendations, any frauds, any misstatements, okay, we will be discussing all in detail. Understood? This is our overall objective of the auditor. Now, last thing of this chapter that is left for discussion is the review engagement. If you recall our yesterday's discussion or last session's discussion, there are two types of assurances. One is reasonable assurance, other is limited assurance. And for the example of reasonable assurance is our external audit that we just discussed, audit basically. In the audit, reasonable assurance, we provide a high level of assurance, right? Because why do we get our accounts audited? There are multiple reasons. First reason, statutory requirement, legal requirement. Why? Because company is a independent legal person. Okay, and shareholders are the separate persons. And as per the law, if you remember, if you have studied the law, company law, corporate law, company is a separate legal person and owners are the separate legal persons. And the company is run and managed by the board of directors. Those are the third party. So just to secure the interest of the shareholders who are the owners, okay, the statutory laws, legal corporate laws of the companies or the countries requires the companies to get their financial statements audited from the concerned like independent eligible experts which we call chartered accountants or ICAW qualified, CA qualified, CPA qualified. It depends in which country you are doing all this stuff because each country has its own requirements, eligibility requirements. If it is required by law to get the accounts audited, then company will go for the reasonable assurance that we have already discussed in detail. If it is not required by law and the shareholders wants to get accounts audited in details, mean they want to get their accounts financial statements in detail, they will go for the audit assignment. They will engage audit firm. They will ask them to audit their financial statements and review that and give the audit report. If that is not the thing, if the management and the company's board of directors are the same, sorry, management and shareholder are the same. Normally in small companies, shareholders and board of directors are the same personnel. So in that case, there is no risk of the fraud, etc. Because both people who are managing the business are same as the shareholders. In that case, they somehow they can like decide to get their accounts reviewed at least by independent person, third person. So because the audit is costly, why? Because in the auditor performs test in details, he performs in-depth work, and that is why it is costly. But in the review engagement, because we are getting negative assurance, no, not negative assurance, limited assurance. Okay, so in that case, cost is very less because the scope of work is less. Auditor will be performing, doing some inquiries, some performing some analytical procedures, and because in that case, he will be giving us a limited assurance. But if you remember, we discussed in limited assurance, or while giving the opinion or conclusion, practitioner, which means auditor, use the negative approach. Like he say this way: during the review of the financial statements, nothing came to our attention that causes us to believe that these financial statements are not prepared in the accordance with the IFRS. Although he is trying to say that financial statements are not misstated, but indirectly he is also indicating that nothing came into our attention. There could be something, right? This is how he's engaging. Why is doing that? Because he has not performed the detailed procedures. He just analytically reviewed the financial statements and all that stuff. Okay, just reviewing the data overall, at the larger perspective, you cannot give a detailed or high level of guarantee about anything or assurance about anything. That is why he is communicating his opinion or his conclusion with a negative approach. Understood? This was our chapter 1, and this we discussed our audit introduction. We discussed our assurance engagement, assurance types, limitations of the audit, benefits of the audit. One thing is left, which is called expectation gap. Okay, just I remembered expectation gap. So what is expectation gap? This is basically expectation gap is the gap between the expectations of the users and the responsibility of the auditors. Who are users? Shareholders, government entities, customers, suppliers, key employees, and the general public. These are all multiple different stakeholders in a business. So what is, for example, how can we say that there's a gap between the understanding of the or expectation of the users and the responsibility of the auditor? Responsibility of the auditor is to obtain sufficient and appropriate audit evidence and express his opinion. Understood? Now, what public is expecting? Public is expects that it is responsibility of the auditor to prepare the financial statements. But if you remember, in our preconditions, even before signing the engagement letter, we agree this with management that they are responsible for the preparation of the financial statements. Understood? So this is a gap. It means the reality is that management is responsible to prepare the financial statements, but as per the general public perception or the stakeholders' expectations, auditor is responsible to prepare the financial statements. Second example is, as per the general public perception, auditor performs 100% audit, and auditor gives absolute assurance, 100% assurance that financial statements are correct in every perspective. But in reality, auditor does not give absolute insurance. Auditor gives only reasonable assurance, and auditor does not perform 100% audit. He do audit or does audit on the basis of sampling. Understood? Next thing, what is the next possible expectation gap? Fraud. As per the general public perception, auditor is hired, auditors does do audit to identify the frauds. But in reality, and as per the auditing standards, auditors does not do audit to identify the frauds. Auditor responsibility is to make sure that financial statements are true and fair in accordance with the IFRS. Okay, we are doing audit on sampling basis. It is the responsibility of the management to establish effective internal controls to avoid any possible frauds or intentional errors. Understood? This was my expectation gap. So we have covered our chapter 1 in detail. I have discussed all the areas. If you have any question regarding any point of the chapter 1, you can ask me right now, or even you can ask me in the group as well. I would request all of you to review chapter 1 before the next class. So when we are moving to chapter 2, you know everything about chapter 1. If you have any questions, you can ask before the next next class, and then we will go forward with the chapter number 2. So if you have any questions for the today's discussion, please ask. Otherwise, we are good to go. I'm just waiting for your questions. If you don't have any questions, just confirm me in the chat box so we can end this session. Okay. Anyone else? All right. It means no questions for today. All right, everyone. Thank you so much. So see you in the next session.